Welcome back to The Explainer. We're jumping straight into what is easily one of the most fascinating turnaround stories in the global consumer sector right now, Estée Lauder. Let's get right into it.
Now, to really grasp Estée Lauder's underlying strength, you have to look way past just the makeup. You have to recognize the absolute powerhouse portfolio of premium and luxury beauty brands they own. We're talking La Mer, Tom Ford, Labo, Clinique, Jo Malone London, MAC. You know, building a global luxury beauty brand from scratch, that can take decades. And that massive premium brand equity, that is Estée Lauder's ultimate competitive advantage. It gives them global distribution, crazy pricing power with high-end consumers, and a formidable barrier to entry against any upstarts trying to muscle into the luxury space. But despite this incredible roster, it's no secret the company has spent the last few years stumbling, battling supply chain issues, persistently weak demand in Asia, and some really heavy margin pressure.
Okay, let's dive into this, because we're seeing a massive shift in investor sentiment right now. For the past several years, the market has essentially been asking one very pessimistic question. Can Estée Lauder just stop shrinking? But suddenly, that narrative has completely flipped. The new question on Wall Street is, can Estée Lauder actually turn returning sales growth into sustainable double-digit earnings growth? And you can tell investors are paying incredibly close attention again. I mean, just look at the stock's recent 16% post-earnings pop, rocketing up to around $98 a share. The market is clearly sniffing out a recovery, but we need to see if the underlying financial data actually backs up all this hype.
Well, here's the data that caused that massive shift. The fiscal full-year results just dropped, and honestly, it's a bit of a plot twist. Full-year reported sales hit a massive $15 billion. But the absolutely crucial metric hidden in this report, their fourth consecutive quarter of organic growth. In Q4 specifically, reported sales grew 6% and organic sales grew 5%. Now, I want to emphasize that word organic here, because it proves this turnaround isn't just some mirage created by favorable currency fluctuations or a bunch of recent acquisitions. No, the core business is actually starting to pump blood again. Consumer demand is genuinely reaccelerating.
Now, what's really interesting is exactly where that growth is coming from. If we put on our financial detective hats and unpack the evidence segment by segment, a really clear story emerges. Fragrance is up a massive 10% in Q4. Skincare is also doing a ton of the heavy lifting, growing at 7%. Makeup is dragging just a little bit with a 2% growth rate, and hair care, which includes brands like Aveda, actually lagged slightly, coming in at -1%. So while the overall macro picture is definitely recovering, it is clearly fragrance and skincare that are pulling this entire company forward right now. They're the ones offsetting those weaker segments.
So let's zoom in on that standout performer for a second. Fragrance is really emerging as Estée Lauder's hidden gem, their strongest growth engine right now. For the full year, fragrance sales pulled in roughly $2.8 billion. And this matters immensely. Why? Because luxury fragrance has incredibly attractive business characteristics. We're talking exceptionally high brand loyalty, immense premium pricing power, strong gifting demand basically year-round, and crucially, a really strong appeal to younger consumers. Brands like Labo and Tom Ford are absolutely vital here. They expand the company's exposure to premium consumers who are more than willing to pay top dollar, which, you guessed it, ultimately translates to incredibly attractive margins for the entire business.
And this momentum builds on another massive global driver for the company, China. Historically, weakness in Chinese luxury consumption and Asian travel retail was easily one of Estée Lauder's biggest, most persistent headaches. But look at this catalyst. Asia-Pacific sales increased approximately 9% in Q4, and that was heavily led by a recovery in mainland China. This is a complete game changer. See, the company doesn't actually need spectacular world-beating global growth to win. Even a moderate recovery in the Asia-Pacific region fuels incredible operating leverage for the entire business, basically reviving what used to be their most profitable geographical segment.
Now, of course, this returning growth isn't just happening by accident. Behind the scenes, CEO Stéphane de la Favre has been aggressively implementing what they call their Beauty Reimagined strategy. Basically, this is a painful but totally necessary three-step restructuring plan. First, reducing costs, which unfortunately meant roughly 10,000 job reductions. Second, restructuring operations to fundamentally improve supply chain efficiency and prevent those awful inventory gluts we saw over the last few years. And third, laser-focusing their capital investments into high-growth brands and new digital channels like TikTok Shop. It's an aggressive, definitely painful short-term plan, but management notes it has already generated approximately $1.2 billion in gross benefits. So the medicine is bitter, but it's clearly working.
And this brilliantly illustrates the real earnings catalyst for the bull thesis, 12.7% to 13.5%.
That is management's adjusted operating margin target for fiscal 2027. This is a massive, incredibly confident signal to the market. It tells us that management fully expects all that painful restructuring and aggressive cost-cutting to actually translate directly into bottom-line profitability. They are setting a firm expectation for expanding margins over the next couple of years. And honestly, that is exactly what you want to see when a company is coming out of a turnaround phase.
To fully grasp why that margin target is so exciting, we have to anchor back to a fundamental financial concept here: operating leverage. This is when a small increase in revenue produces a much larger percentage increase in profits simply because your fixed costs are completely optimized. Because Estée Lauder has ruthlessly cut so many fixed costs through their restructuring, they literally don't need 10% revenue growth anymore to see explosive profitability. If they just get, say, 3 to 5% top-line sales growth, combined with these newly lowered costs and potential share repurchases, man, it can lead to massive exponential earnings per share or EPS growth for shareholders. But I do want to pump the brakes for just a second and offer a quick insider tip for savvy investors looking at these numbers. For fiscal 2027, management's adjusted EPS guidance sits between $3.10 and $3.35. And yeah, that actually beats Wall Street's expectations. However, compare that to the GAAP EPS guidance, the standard accounting numbers. That figure is considerably lower, sitting between $2.52 and $2.85. That gap right there, that reflects the heavy, real-world cash costs of this restructuring plan. As an investor, you absolutely cannot just look at the rosy adjusted numbers. You have to respect the GAAP numbers, because those restructuring efforts require actual cash going out the door.
Speaking of cash going out the door, let's briefly touch on the balance sheet. I would classify it as manageable, but certainly not pristine. They've got a solid $3.13 billion in cash and equivalents on hand, but let's be clear, they are absolutely not a debt-free company. They carry substantial long-term borrowings. Now, their long-term credit ratings do remain investment grade, and they definitely have adequate liquidity right now to support their day-to-day operations, their capital expenditures, that expensive restructuring we just talked about, and, of course, their dividends. But given that debt load, it is absolutely a core area to keep an eye on moving forward.
Look, every turnaround has hurdles, and Estée Lauder is not some low-risk consumer stock. We need to be objectively aware of a few major threats to this thesis. First off, a renewed slowdown in Chinese luxury consumption or Asian travel retail, that would severely hurt their momentum. Second, we could definitely see continued weakness in their makeup and haircare segments, particularly the Evaded brand. Third is execution risk. I mean, rebuilding global brands while firing 10,000 people and totally restructuring your operations, it's a bit like rebuilding an airplane mid-flight. And finally, there's a broader macroeconomic risk. If high-income consumers pull back on discretionary spending due to inflation or a recession, premium beauty will eventually feel the pressure.
So, the crucial point here is valuation. What multiple should an investor truly pay for a turnaround that is still, very much in progress? Before the earnings report, the stock was hovering in the mid-80s, offering a very decent margin of safety for the value investor. But with the stock surging 16% to around $98 a share, we kind of have to admit that safety net is mostly gone. If they hit that adjusted EPS target, a $98 stock price implies a forward PE ratio of roughly 29 to 32 times earnings. That is simply not an obvious bargain anymore. The market is already assigning a significant premium value to a successful turnaround, meaning there is very little room for management to stumble here.
Let's systematically walk through this and objectively weigh the risk versus reward. In our bull case, where execution is flawless, meaning they achieve 4 to 5% growth, the China market fully recovers, and margins expand beautifully, the stock has the potential to hit 120 to 140 plus over the next few years. Now, if we look at a more moderate reality in our base case, assuming 3 to 5% growth and a more gradual margin expansion, fair value sits right around where it is now, maybe stretching up to about a 115. But we have to respect the bear case. If the China recovery stalls out entirely, if restructuring stays persistently expensive and margins just fail to expand, earnings are going to disappoint, and this stock could easily slide all the way back down to the $65 to $80 range. So, synthesizing all of this data together, Estée Lauder earns a 7.5 out of 10 on our scorecard. The fundamental business quality and their immense brand moat are absolutely excellent. The turnaround potential is undeniably high, backed by the reality of organic growth officially returning to the top line. The financial risk? Moderate, given the balance sheet. But the operational execution risk definitely remains high. Ultimately, the biggest factor holding this score back from being an 8.5 or a 9 is the current valuation. Following that aggressive post-earnings jump, it sits firmly in fair to somewhat expensive territory.
Which leaves us with one final, vital question. Is the turnaround already priced in? Estée Lauder is no longer just a declining luxury beauty company. It is in a compelling, highly verifiable turnaround phase. But for conservative investors, chasing a 16% one-day rally is rarely a winning long-term strategy. The smart move here might just be to keep this stock closely on your watch list and look for opportunistic pullbacks toward the $85 to $90 range. That would vastly improve your margin of safety. Keep an eye on those organic sales and margin expansions in the next few quarters, because if they hold up, this is going to be one of the most exciting consumer stories of the next 3 to 5 years. So what do you think? Has the easy money already been made, or is the comeback just getting started?